This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report. For every podcast I put out, I also put together a blog post that features notes and links related to the conversation. Many times there will be charts and reports as well. So if you haven't already, go to thefelderreport.com and check out what you've been missing. This is the third conversation with Diego Parrilla I've published as a podcast, but the fourth time I've actually recorded a discussion of ours. The first time, Diego was kind enough to share many of the facets of his investment process. I found only afterwards that due to a technology issue, the audio recording was sadly unusable. So I was very glad to prevent the possibility of another such mishap by having this conversation in person. Though it was the Holy Week of Semana Santa in Spain and Madrid was relatively quiet as a result, I found Diego and his team toiling away in their top floor offices at Quadriga Funds. Considering Diego's views have been so prescient of late, and his framework for approaching markets so relevant to the current environment, I was especially glad to have the chance to talk with him again. So please enjoy my latest conversation with Diego Parrilla.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Diego, welcome back to the show.
Thank you for having me, Jesse.
Well, thank you for hosting me here in your beautiful office. It's an absolute pleasure to be here in Madrid and be able to do this in person. It's wonderful. We've done a couple of these virtually, but it's nothing like being face to face. So thank you for hosting me here.
It's my absolute pleasure.
Yeah. The last time we spoke, I think it was almost exactly a year ago. And at the time, I think it was March of 2021. It was right around the time all of the meme stocks were flying, going to the moon. And, people were talking about stonks and, how the market only goes up. Things have changed dramatically. In your latest piece, you write about how, bonds just had a terrible first quarter. Commodities are ripping higher. And a lot of these popular meme stocks have absolutely crashed in the last 12 months. So what do you think has fundamentally changed over the past year to create this dramatic shift in markets?
Well, I guess what took it there in the first place. I think if we take a big picture of what's been happening at the macro level, we've seen decades of what I would call monetary and fiscal abuse, whereby every time we face a problem, we don't really solve it. We basically do a few things. We delay, transfer, transform, and enlarge the problem. We delay, by just adding debt and spending, which obviously it's an intergenerational issue. We transform because monetary policies, printing money, has this domestic angle where we sell things based on what's convenient, but there's obviously a very important angle that is more foreign about currency wars and its mirror image, which is trade wars. It just creates this escalation, which has led to artificially low interest rates and as a result artificially higher valuations and highly distorted dynamics on the global scale. And clearly, once you abuse this, it gets to a point where you are also transforming this problem. And the transformation of the problem is mainly into inflation and inequality, both of which are becoming much more obvious since last year. And ultimately, the realization that all these things we've been doing are only enlarging the problem with bubbles too big to fail, systemic, etc. But I think within the framework of the anti-bubbles, you get enormous complacency as well. And I think last year, this idea, this belief that you can actually print and borrow and inflate your way out of trouble without any severe consequences is what took us there in the first place. And what we're seeing right now is more of a normalization. Something's going to give. You have an impossible balance for central banks to try to keep artificial setting of valuations and inflation, and something's going to give. And that's in some ways, to understand why we had those huge valuations on the first place. The simplest way to look at it is, the way I summarize the last decade is the transformation of risk-free interest into interest-free risk. You have a dynamic whereby bringing interest rates down to zero or even negative in places like Europe, or simply artificial low interest rates. You don't need to be a PhD to understand that at 0% nominal rates, the present value of $100 in 1 year, 10 years, 100 years, or 1,000 years is par. And so when you have artificial low interest rates, you're effectively creating the mirror image, which is artificially higher valuations. And I keep saying the word artificial because that's effectively what we've constructed. And that leads to wealth effect. This is this illusion of wealth.
Right.
And whether you look at the meme stocks or on a more controversial basis, crypto or others, this wealth effect that is created, this illusion of wealth, which I define as, unrealized gains that can never be realized. It's just this impression of wealth.
Right.
If everybody tried to monetize it doesn't exist. It vanishes where it came from, into thin air. And that's in a way what we're seeing is this enormous complacency, this FOMO, these other factors that happen within a highly artificial setting, which invariably delay, transform the problem. And we're in a situation right now where this mindset is changing. This game is changing, and that's why some things are normalizing in some way. But I would argue that it was last year that was completely off. Is not what's happening right now is much more of a normalization of something that was very artificial. But we've got ourselves into a big trouble to see how we come out of this.
Right.
Because again, what we've done is only done. It hasn't solved anything. It has really enlarged the problem.
Yeah. And I love how you, I guess just in listening to you talk and in reading your latest piece, I just have been thinking about this idea that every bubble is built on some widespread misunderstanding. And from listening to you talk, it sounds like a lot of this bubble has manifest in duration, in discounting cash flows at much too low of interest rates. And I think behind this idea that got people so comfortable with a lot of these things, whether it's crypto or growth stocks that have no cash flows today, but maybe will 10 years down the line, is that there was a widespread belief in the idea of secular stagnation and the idea that inflation was gone forever and wouldn't come back. And so now that inflation is here and it's looking like it's more than transitory, people are having to reassess. Do you think that misunderstanding about the nature of inflation and the nature of our inflationary environment is behind a lot of these changes in asset prices?
100%. I think the rules of the game are basically written in from a game theory perspective. We all know what happens when central banks lose independence. When your central government is able to tap on the printing machine to basically access free funding, right? And this is something that I pointed out earlier, is the transformation and the transfer of problems. Think about governments like Spain, where we're now, being able to borrow money at negative nominal rates. Let's not fool ourselves. As much as I love my country, it's not a fair reflection of the fundamentals of where we should be borrowing. It's 100% artificial. And it's the result of the central bank printing infinite amount of money to basically fund this. So obviously the governments will take it at those levels. And obviously you end up, if you have that belief, that complacency, you may end up taking too much debt, which means when you need to normalize things and you try to normalize interest rates, you're just simply unable to fulfill your obligations. And this is why this this stupidity, this recklessness, this short-term, long-term trade-offs. They might give you some degree of short-term stability, but ultimately create long-term problems. And I think here the issue is that once it's a bit like I talked in the book, from an engineering perspective, stable equilibrium, unstable equilibrium, and meta-stable equilibrium. So you have within some boundaries you're in equilibrium, but once you get out of those boundaries, things scale out. And this is unfortunately a situation with inflation, right? I mean, this is where we're now. And I think it's worth tying up maybe with, this analogy I use, these three levels of the investment game. I have teenager kids, so I would say, look, if investing was a video game, it would have three levels. And level one is where most of us have been playing for decades, for pretty much our entire lives, at least in the Western world, which is, can you make money in nominal terms? Meaning, can you take your $100 or euros and turn them into 101 or whatever? When you actually think in nominal terms, invest in measured in nominal terms, get recognized, rewarded, everything happens in nominal terms. This is largely a world of where inflation is somewhat negligible. Okay, and this is the game that central banks have played in some ways. I think this 2% official cap and target for inflation, I've always said that is high enough that it will dilute you by 20% plus compounding over 10 years, but it's low enough that many of us will disregard it, right? And so in a world where once upon a time we had 5% nominal rates and fairly low inflation, you could pretty much think of the game in nominal terms. But we're now decisively in level two. And level two, it's a level where you need to make money in real terms. And this is not just, this is about, can you protect your purchase power? Your $100 might be worth 101, but inflation at 5 or 7 or 10 or whatever percent means that you're actually losing, for 7, 10, 9, 10% in real purchase power. And this is a dramatic change in the rules of the game, because actions that would win in level one are actually major losers in level two. So who loses in level two? Obviously, anything that is short inflation. So cash, fixed income, and credit in particular. So if you think about, my 100 euros, I'm going to invest in Europe. We've had a situation where your 100 euros, best case scenario is they would give you back 99 in 30 years.
Right.
Okay, that is linked to this idea of deflation, and I'm doing so well.
Right.
This is the opposite. Your 100 euros that are going to pay you back 100 or 101 in 30 years, I really think they're going to buy you pretty much nothing in 30 years in real terms. And so this is a level two where we are now, where things are changing dramatically. And I would argue that, we're on our way to level three, just to complete the picture, which is, can you make money in real terms after taxes? And this is, you might wonder, well, taxes are already very high. Yes, they are. And taxes have been, as Mark Twain would say, there's two certain things in life, death and taxes. They've been a part of the game for a long time, but I think we are about to see a meaningful increase in wealth taxes. And this is, I think, the way central banks and governments square the circle, right? You start out with a problem, you try to print and borrow and inflate your way out of the problem. This creates this huge inequality where obviously the poor people suffer the most, and the rich people, the haves and the have-nots that Ray Dalio would talk about. And how do you square things with populism, and basically trying to take the money from the rich back to the poor. And this is again this dynamic which is at play, and I think that the mindset from investors going from level 1 to level 2, it's huge, it's very important, and that's why I wrote this new piece to try to bring an analogy that would basically bring it home in terms of understanding how things are playing out.
Yeah, well, I love the way that you frame it, because it helps you understand the psychological shift that I think investors are going through as they come to this realization that inflation is here to stay. And it does explain what's going on in the markets as you see, bonds, getting hammered and commodities starting to take off. But I think it also, maybe helps to think about some of these misunderstandings behind inflation, because I just keep coming back to this wonderful book by Goodhart and Pradhan, The Great Demographic Reversal, that talks about how we believed for a number of years now that demographics have been disinflationary. And the truth is that aging societies are actually inflationary when you think about it. We can talk about that if you want, but you make the point too that central banks have maybe counted on the fact that globalization was a permanent force that was going to be disinflationary permanently. And then also, in your wonderful book, The Energy World is Flat, you write about how there was going to be a crash in the oil price, but commodity prices have been depressed for a number of years, and there's been lack of investment. And so these forces of globalization and low commodity prices have given, I think, investors and central banks a sense of, wow, we really have killed inflation. But now all of these things are reversing. You mentioned, globalization in your recent piece, and obviously you've been very interested in commodities throughout the course of your career. So maybe you can kind of discuss about, structurally how these things have changed in a way that investors maybe haven't anticipated.
You touch on so many important points right there. And maybe I talk a bit more detail about this analogy of the frog in boiling water.
Absolutely.
We go one by one with some of these points. So I think most people will be familiar with the story, that goes that if you put a frog in water and you boil it and you bring it to boil at a very slow pace, the frog will not notice and it will eventually die from being boiled. However, if you you throw the frog into very hot water, or you heat it very fast, and it realizes it will jump out. And this is an analogy I've been using for a long time. It was in my book in 2017 in the anti-bubbles, and in this newsletter I sort of push it a little bit further with this idea. So let's start with the point that we're all frogs in this monetary broth of monetary and fiscal. What's happening here? Well, central banks. The first thing I would say is there's like an official thermometer.
Right.
So what's the actual temperature of the water? Well, the official thermometer is the official inflation data, right? Which is controlled by the guy who's heating the water, right? So this idea, as I said earlier, of the 2% official inflation is it's designed scientifically so that us frogs will stay in the water. Okay, it's been heated, but not so fast that just 2% per annum we may not notice, but it increases and it compounds, right, every year. That's my first point. The second point is the actual real inflation, the pace at which it's going up. As a rule of thumb, I would say is at least twice the official inflation. And if you run the numbers and you understand the power of compounding, you see that the temperature will increase exponentially very fast. So in that sense, it's important to understand that our inflation baskets are very different as well. Depends on where you are in the growth or your situation. Some people here in us might have nappy inflation because they have little children, and I might have university, right, etc. So this idea that inflation was just one number and it's the official number, it's all linked to this point you're making. Now, I think on the inflation-deflation debate, there are clearly some deflationary forces in the system. You know, you might open the window, you might have other ways in which you're funneling the water, whatever. And demographics has, for a long time been viewed as deflationary, but there are many other things. And I think technology is probably the best known case of something that gives you, benefits in terms of your TV. I guess it's been a constant price. They just keep getting bigger and better sound. So in some ways, you're paying the same price for something much better. That's deflationary, right? All else being equal, if you wanted to buy the same TV from 10 years ago, you buy it for a fraction of the price today, right? So I think the important thing to understand is that there are very strong deflationary forces in the system. They are there, undeniable. However, they are partially or totally or more than offset by one single force, which is money printing. The moment you're focusing on, think about the monetary broth, right? If you have control of the fire, how much you want to heat you want to apply, and it's a very cold day and your windows are open, whatever, what it means is you can actually put even more fire without feeling that temperature. But there are limits to that. How cold will eventually things be? What happens when things normalize? You need to close the window. Maybe it's actually summer. So this is a little bit what happens. Central banks apply this enormous amount, which eventually might need to normalize. And if you don't, then obviously it shows how much heat you're really applying to the water. So the frogs are not getting the benefit of deflation that you would get because the water should go down. Because the central bank says, oh, thank you very much, technology, it means I can actually print even more. So if you think about a hole being on the ground where deflation actually digs this hole through technology, the central banks are literally filling the hole with paper. And it looks like it's stable, but it's not. And then when the tide goes up and things happen, we're left with these forces. So the critical thing to understand is that, they're telling us the narrative, don't worry. Yes, last year I increased the temperature by a lot, but it was just a one-off and blah, blah, blah. The reality is it's not. It's much more structural, as you say. And so in that sense, the critical dynamic, in my opinion, and the reason why now? Why suddenly is this rush? Why, right? Why are the central banks now, after telling us all this stuff, why now and why so quickly and why so aggressively? And people that were incredibly dovish are now super happy. Why now? And it's very simple. It's inflation expectations. Why did the frog jump? Why do frogs jump? Frogs jump out of the water because they feel the temperature going up very fast, and they feel that the expectations that the water will continue to rise, the temperature will rise very fast. And these are the two reasons why we jump. Either because current inflation and the pace at which it's being heated increases a lot, and second, we realize no. So the critical thing to understand here is what happens when frogs start to jump. And this is something that effectively the central banks start to lose control. In a world of low inflation, they can apply a lot of heat, all the frogs are there, they're going to eat their lunch. Now, when frogs start to jump, the central bank has a problem. They see other frogs jumping, the frogs are jumping out. What it means for the markets. Let's look at fixed income. Okay. There is this dynamic where people would argue that this is conventional wisdom, right? Long-term interest rates are the reflection of how high short-term interest rates will go. So you would say long-term interest rates go up because we're going to hike short-term rates. I've argued for a while that it could be the opposite. It's actually long-term interest rates or long-term yields go up because you don't hike. Mm-hmm. What I mean by this is if you don't hike and you have too much heat, too much liquidity, too much inflation, the frogs start to jump. What happens when us frogs start to jump out of the 30-year treasury? Mm-hmm. Of course, if China jumps or Russia or any big institutional investor or whatever, we jump out of the broth. Obviously, the yields will go up. What happens when yields go up? Well, whoever is been financing themselves at that rate, the government or whoever, is going to suffer. So we have this situation where it creates this process where yields start to go up and start to go out of control, and it forces the central bank to basically intervene. And that's why I think you'll have a reversal, not only of the hikes back into QE, but you go one step further, which is yield curve control. Yeah. And I think that's something that if the frogs start to jump and we start to lose control, there's going to be no choice. You can, just to complete the analogies, and I think this is very important, is why frogs stay in the water. Even if you know and you notice that the water the temperature is increasing a lot and you might increase, and the answer is benchmarks. Mm-hmm. I mean, think about this, lifers or different companies that have very strict benchmarks on. Basically, they're handcuffed. They're frogs handcuffed to the water, and they can see it coming, and it's really sad because they know it's coming, but there's literally nothing they can do. They're handcuffed to it, and I use this stupid analogy of your benchmark says your doctor told you to take 5 cyanide pills and you take only 4, and you're like, I'm underweight cyanide pills. It's like, dude, you're kidding yourself. Right. So I think the analogy kind of helps understand a few dynamics, and I do think we're at that point. You asked a few other points on globalization and the structural nature of commodities, and this is really a key question: is to what extent can monetary policy basically reverse and stop what's happening, and time will tell. But I think this is.
Well, I think it's fascinating that you to discuss what long-term interest rates are doing, because that is another reflection of this inflationary mindset. But I also like that you bring up benchmarks, because I think there's a question that goes above the 3 questions that you asked before. Before, can you make money in nominal terms? I think a lot of investors think, can I make money in relative terms to the benchmark? And can I do 2%, 3% better than the S&P, even in a year the S&P is down 20%? That's not. Or can I do 2 or 3% better than the 30-year Treasury performance, even if that means I'm still down 10 for the year? That's a mindset, I think, that is
level 0.
Yeah, that's not a wonderful thing. And I think more people are going to be moving to these other mindsets of absolute returns and then real returns and these types of things. But to come back to the inflation debate again, I love the metaphors you use about the central bank turning up the heat, because I do think, if you look back to what Jay Powell said in 2019, he mentioned, and he did walk this back afterwards, but he did say, too low inflation is the greatest challenge of our time, in roughly 2019, I think. And so they were clearly of the mindset that secular stagnation and deflation, these were the challenges they had to fight. So when the pandemic came along, they turned the heat up all the way. Let's turn it up to high, and because we have so many deflationary forces. But what the pandemic did was it accelerated the process towards deglobalization, which is inflationary. It also accelerated the inflationary demographic shifts of people retiring and leaving the workforce, and the supply of labor shrinking. And so we saw a lot of these inflationary forces actually pick up steam at the same time the central bank was applying a ton of heat to this fire. So now they're in this situation where they've clearly overdone it. And the economy has overheated. And you bring up the point, do they even have the power? They can walk back what they've done, but can they address deglobalization? Can they address demographics and a reduction of the labor supply relative to the overall population? And the trends toward populist politics that all these things have resulted in. Monetary policy can't really address these things, can it? So it leaves them in a difficult situation.
No, I think, again, you bring in great points. I think one of the things people must understand is that there's a very significant delay in between action and reaction in monetary policy and fiscal in some ways. I use the analogy, and I wonder if it's happened to people listening to us. You go to the beach, you don't apply any sun cream, you spend the entire day there, and it's only by the time it's you get back home at night that you're completely and utterly burnt, right? And you're like done. So there's a little bit of this. You could also use not only solar radiation, you could also use nuclear, which is obviously more deadly. So you could probably have a walk around Chernobyl and just having a laugh with your friends and play a football game and just be there and say, come on guys, there's nothing happening here, only to know 2 weeks later that you glow at night and things happen. So if you are not mindful and you apply way too much radiation to the system, the damage is already done. Mm-hmm. And I think this is the point I keep making, and why our grandparents introduced these limits, right? I mean, in inflation and printing and whatever, they've seen this movie. They know the grandparents are the ones who want us to apply sun cream, right? Mm-hmm. And I also, a point I missed earlier, if anybody's listening from Latin America or emerging markets, they've been playing in level 2 for a while. I mean, they have such an advantage against us, right? Because they've seen this already. We don't need to be rocket scientists to know what happens, right? And so, to your point on globalization, I do think the pandemic, as you well pointed out, has effectively highlighted some of the weaknesses and deficiencies of the system. One of them is this idea of becoming overly reliant on just in time and the perfection of globalization. And if I go back, I would bring it to currency wars and trade wars. I mean, in some ways, why did we ship or investment, employment, technology to China or whatever? Sometimes it's because of artificial interest rates, very cheap labor, very aggressive fiscal deals, right? Mm-hmm. And so, of course, the short-term nature of the business means we are going to go there and give them our employment, our everything, and then you realize that things happen, right? I mean, we've seen bottlenecks obviously highlight this with the inability to go. But I think there's something more structural. I think this transformation of the problem, the populism, the extremism, the nationalism are consequences. Trade wars and imposing tariffs is not only a defense against monetary abuse, it's also protecting your own people. And so the idea of buying things that are domestic are not only helping you, but also are safer, right? So we go from I think there's been a dramatic shift you see now. I mean, lots of headlines. I mean, wheat, no? So Egypt just acquiring strategically energy security, food security. There's an element of not just having enough and doing things just in time. You're going into just in case. You're going to resilience economics, and this is something that again goes back to inflation. I mean, if you have expectations of shortages, of course you're going to hoard. If you're China, why wouldn't you shift your wet paper called yuan into things like oil or whatever? There's a first mover advantage for government to print money and take all these assets while all the frogs don't realize the effect. So I do think that geopolitically as well, this trend of deglobalization is actually leading to a polarization of the world. And I don't think Russia did this Just like that, I think they did it with their eyes open and implicit support from a part of the world. And yeah, this is adding to what we've discussed.
Yeah, we haven't even really discussed the inflationary implications of a de-dollarization around the world. I think that there were a lot of inflationary impulses even before the war in Ukraine. Obviously, the war exacerbated a lot of those issues related to food security for a lot of countries, but also just in the wake of the sanctions imposed upon Russia. There are a lot of people speculating that this could have an impact on people's willingness to transact in dollars and invest in treasuries. So that seems to be another. I guess what I'm trying to point out is it seems like the central bank in 2019 counted on disinflation and low inflation to be able to continue the monetary process they've had going for 10 plus years now. And now everything seems to be conspiring to remove their ability to do that. Now it looks like after all this monetary expansion that we've seen, already we're seeing signs of potentially heading towards recession, right? People are talking about the yield curve inverting. But also, as an equity guy, I look at the trucking stocks imploding, retail stocks rolling over, home building stocks, all these, inside of the stock market, as Stan Druckenmiller said, is the best economist he's ever seen. And right now, it's pointing to a real weakening of the economy. So the Fed is really tasked with reining in inflation at a time when they may have to force recession and pop the asset bubbles in order to try and bring inflation under control. You've said in this environment, the markets, the economy is much more fragile than it was in 2018. Yeah. So how do you see this progressing, this challenge for the central bank as?
I think it's very important to understand that the central banks are trapped, right? They have this problem called bubbles to fail. I think they've created this beast based on complacency, and the wealth effect, if it unwinds, is big. And on the other hand, they have inflation. I think there's an interesting debate with respect to populism, what it means, right? It comes obviously from Latin populus, from people, right? So populist measures are those who are favor the people, right, or the majority of the people. This is an election year in the US, and under normal conditions, you would use this as a factor to say, they're not going to let the stock market go down because it's an election year, and every year, well, this goes with the view that the populist thing to do is to have higher equity markets. The thing is, the enemy today is different. The enemy today is called inflation. And here in Europe, it's a different situation to the US, but I would believe that the populist movement, the narrative is starting to, basically look at inflation as a much bigger problem. So guess what? If the stock market is down 20%, then fine. You rich guys have 20% less, you're still mega wealthy, and you still have your houses and whatever. But the real issue is what's happening to the poor crowds. And so this could have an interesting effect, because we talked earlier about the change of mindset on the investors as we go from level 0, as you pointed out, 1 and then 2 in real terms. But what happens to the regulators? What happens to the central bankers, the governments? And I think inflation is also changing the mindset. The ironic thing is they're the ones who created this problem in the first place, but they have to pretend that they're doing something about it. And this is the reason why you could expect very strong action, because they are, in a way, looking for, obviously Putin is now guilty of everything, but they will try to find scapegoats. They have to pretend that they're doing something about this. But it's important to put things in perspective. Okay, first of all, what sort of hikes are we looking at, right? We are talking about hikes that are bringing us to perhaps, 2.5%, 3%. Okay, when inflation as of writing today, or speaking today, we're heading into one of the biggest inflation data releases, but it's in the region of 8%. So let's not fool ourselves, okay? They pretend they're doing something about inflation. We're fighting inflation, but guess what? Interest rates in real terms are very, very negative. Every day that goes by, it's very negative, and it's negative carry for all these things. And so the question is, one of the big questions is, are we able to normalize things in a way that we go back to level 1? I don't think so. I think we are likely to stay in level 2 for a while. Real rates are going to stay very negative for a while. And this is really bad news for some stuff and much better news for others. The second point that I think is critical is, when you think about this 2.5% terminal rate or the 2.5%, why that number is so important is because if for those old enough to remember Q4 2018, we had a situation where Powell was in autopilot, right? You remember hiking rates after a very long period of monetary abuse. But what happened is once we got to 2.5%, things started to happen. So companies that were heavily indebted, because whether it's GE or Ambev or others that pursued very big expansion through debt, found themselves that as interest rates were going up, they're really, really struggling, right? And you had the credit market going and equities collapsing, and then the Fed had to come to the rescue over Christmas. Now, at that point, and this is 2018, the move to 2.5% was already big enough to trigger this tipping point, and we had to bring rates down to 1.5%. Just to contain things a bit, alongside with more printing. My view is today the situation is way, way worse than 2018. And this is why, perhaps one of the biggest and most important questions right now is to what extent are we able to hike rates without creating the implosion of the system. And I found fascinating that our friends at Goldman Sachs, my former colleagues, who I respect a lot, they are putting a strong argument that, the economy is very strong and that we are less sensitive to interest rate hikes. And academically, they're all very good arguments, but I think the jury is out. And we're going to see that quickly. To some extent, the recent move up in equity markets, the bull trap in my view, and feeds back into this bubble anti-bubble dynamic of artificial low vol sucking a lot of people in. But these things that are happening, it's clear to me that a 50 basis point hike is much more likely at 4,600 than at 4,200, right? So in an ironic way, the bull trap is feeding the hikes in a way that right now we're easing some of that. So maybe that's a kind of dilemma we're playing. But I think the important thing to understand is that we already knew by 2018 what would happen at 2.5. The situation is way worse for a long list of reasons, right? I mean, we've had this massive growth in debt, massive growth in printing. We have a war that is creating tremendous disruptions. We still have huge bottlenecks in the system, clear signs of dislocation, clear things that are under the surface that are hurting really a lot of stuff. And so my common sense and judgment and analysis tells me that no, we are probably even more sensitive to than we were in 2018, and that's why I think we may not see the full extent of the hikes that are priced in. We will see central banks, as always, perhaps delaying and trying to factor things in. And this is part of the narrative that they use to try to keep us frogs from jumping, because if we jump, then it creates a really big problem. They will be forced to come and print and finance the amount of outstanding debt, not only with what's already done and needs to be done to continue things, but also to offset the water levels that are being left by these frogs going out, which are going to boil the remaining frogs at an even faster rate. So that's it's all a big change and as you pointed out, all these things that were kind of going in one direction have shifted in the other. And with the mindset of populism changing, you almost know the end game is they have to pretend, they will go for the hikes. The hikes will create a lot of pain. They will have to unwind and slow down the pace without fixing anything. And then you're left in a situation that is way worse than what you started, which is the first point we made in this discussion today.
Right. Well, I find it very helpful, to talk about when we talk about a normalization of monetary policy, right? We're talking about 2.5% was too much. And obviously they had to back off of that in 2018. And then they had to start printing money again in 2019 to address the repo crisis because there was just, too much debt and for the system to handle. I find it helpful. I think I read Stan Druckenmiller has said in the past he would present his investment team with kind of a scenario. He'd say, pretend you came down from Mars, and I'll give you the economic data, and you tell me where you think Fed funds rate is. And so if we just do that today, and you look at Q4 nominal GDP was something like 12%, right? Inflation pushing 8%, unemployment rate around 4%. Where would you guess the Fed funds rate is? And there's no way you would guess it's at 0% and they're printing over $100 billion a month. So when you think about normalizing, I think about something like the Taylor rule, which suggests Fed funds should be 8 or 9% or something today. There's absolutely no way. I mean, if they took Fed funds to 8 or 9%, all hell would break loose, right? I mean, markets would crash, and so just the fact that we're discussing, can they get to 2.5? Can they reduce the balance sheet? It argues, when you think of it in those terms, it argues that, frogs should be jumping out of this water as fast as they can. So I guess my question is, there's already an argument that frogs should be, everybody who's not tied to a benchmark should be jumping out of the water. But I guess the point that you're hinting at too is that there's a good chance they won't even be able to get to 2.5 or reduce the balance sheet. And in light of, the economic data, they were going to be forced to choose between allowing inflation to just continue to run based on a lot of these secular forces we've talked about, or crash the markets. And, by tightening financial conditions to a degree that, requires much lower stock prices in these things. And so, it's a situation that's, for the central bank, that's, not ideal, and for investors, that's not ideal. How do you think, where should frogs be jumping? Where should they be looking to I guess avoid the situation or best protect themselves in this situation?
Yeah, for sure. I think it's interesting because the burst of the bubbles is deflationary. We know that. So you will ultimately fix the problem by destroying everything. But, you look at the experience in emerging markets in Venezuela or Argentina or whatever, which are obviously extremes. And you see the point that I was making, this idea that you can fix problems by printing and debt is not a zero-sum game. I mean, it's path dependent and you end up in a worse position than you started, right? In terms of looking at the current broth, what you are, I think you made me think earlier. Interesting is do I stay in the US dollar broth, or do I go to the euro broth, or do I go to the ruble, or I go to EM? And every broth is being printed and boiled at a fast pace. Think about Japan. We had a very historic event this month. Okay, Japan has always been pushing the boundaries of monetary policy. And they were the first one to introduce yield curve control. Let's talk about this for a second, because I think it's important to understand what it means and why it might be ahead of us. And so when you think about monetary policy, with interest rates and hiking and whatever, that's part of the accelerator. When you go into QE, which was sold to us as temporary, and we quickly realized it was, as always, something that stays forever. In the latest form, it was 120 billion a month. This is your allowance, Jesse. You have 120 billion a month. Go and spend it. And you do that, and you just put it at play, and you buy some treasuries, and you buy some mortgages, and you buy whatever in Europe or Switzerland or Japan. You even buy equities or non-government debt. But that's a big amount, and you're doing it quantitatively. Now, the next step is I need to keep yields low because my debt is so huge. I'm Japan. My level of debt is so ginormous. So I'm going to fund myself at 10 basis points. This is it. The 10-year is 10 basis points. That's what it's worth. Why? Because I say so. And you don't link it at 10 basis points just by doing 120 billion a month. You will do whatever it takes. Mm-hmm. And whatever it takes means infinite amount of money. It shows and it pretends to be a two-way market. Mm-hmm. But in reality, in the last couple of weeks, we've seen the first time JGB's been tapped at 25 basis points. And this is pretty huge news, and it's the reason why dollar yen went. Because and this is something I've been talking about in my book since 2017. When you build this thing and you're abusing monetary without limits, and you have that huge amount of debt, and you can't let yields go up because you go bankrupt, and you have to keep them under control, but inflation is rising and frogs are jumping, it's very obvious. You need to print more to keep those yields low. And this is what might be ahead. So to what extent are the different broths being boiled at different speed? Ultimately, the degree of freedom of the system of monetary and fiscal abuse is always the currency, always. Okay, and you would argue, in fact, the dollar is positioned, even if they're desperately trying to devalue themselves out of this. They're fighting inflation, they're hiking rates, but look at the monetary divergence you're seeing across the world. I mean, China, lockdown, yields crossing. Dollar China is ridiculous. It's one of the most, the yuan, I think it's very artificial. There are reasons to believe that it could go a long way. There are much more strategic battles being played. But they've told us the story of stability, of high yields, of control, and many investors have actually jumped into the Chinese broth, which I think it's good luck to them. It's a bit of a Hotel California, getting in and getting out. And so from a currency perspective, the first thing is, where do I want to be? Which fixed income do I want to be? Which currency do I want to be? And so that's not obvious, right? You may jump from one boiling broth into another boiling broth of currency. You could go into a frying pan, which is equities, right? Where valuations are very hot and with hiking rates and the water being splashed and whatever is gonna. Or you could arguably go into other pieces, other anti-bubbles, other colder surfaces. I personally happen to be a big believer in gold. I've been for a long time, but more because of its real asset nature. Gold happens to have a strong, obviously, monetary angle and historical angle, but generally real assets, real estate, certain real assets I think are going to be very important. So what does it mean for portfolio construction? And I'm going to bring an analogy that I use a lot. I'm Spanish, so I use soccer, European football or world football, but I think the portfolio is a team. Okay, it's a powerful analogy because this is about the team. It's not about the individual players. It's about the performance of the team, and you need strikers. You need midfielders, defenders, goalkeepers. You need things that will do well when the world does well, and you need things that will do well when the world does badly. And this dimension of risk on, risk off, you can paint it in a number of ways. It's a long vol, short vol. It's income versus capital gain. It's a carry play, versus role. There are many dimensions that describe this risk on, risk off. I don't believe in a team with 11 strikers. I don't believe in a team with 11 goalkeepers. And I don't believe in a coach that pretends to have a crystal ball that will say in minute 7 they're going to attack, and then I will attack you, and then this. You have no idea whatsoever where the ball is going to be. You just need to be sure that you have the right players to control the ball, defend, and pass it around and score goals and defend. That's as simple as that. So this idea that investing is about having a crystal ball, I don't subscribe to it. I believe that it's the opposite of having a crystal ball. You actually need a proper team, diversified, that will have pieces that do their own job. I happen to be a goalkeeper with my strategy. We were, as you know, one of the best, if not the best, performing hedge fund during 2020 in February and recently during the Russian crisis. So, yeah, the goalkeeper will do very well when it's needed, and it might suffer and potentially significantly during other scenarios. But this is the power of the team and the power of rebalancing. Now, in addition to this important, let's call horizontal dimension, which is the risk on, risk off, and the balance team and rebalancing, there's a new dimension that comes in level 2, meaning not all strikers are the same. Not all defenders, not all goalkeepers are the same. So when you apply the inflation filter to your team, effectively, I think you need to be in a long inflation bias. And this is why equities are preferred to credit. That's why real assets are preferred to cash. And this is why gold or volatility I prefer to fixed income. Because cash, fixed income, and credit are short inflation. And in the long term, in level 2, they're going to lose you. So I might be bearish in the sense that I think, rates are going up, equities are going to suffer, but I have no crystal ball. Things could happen. Anything could happen. So in that sense, I believe investors need a balanced team that will do well across any conditions. Wherever the ball goes, it's going to be a very volatile game. It's going to be, the referee has been bribed for the longest time, with offsides that were not, and fouls, and the referee is changing the stance. It's not going to allow so much. It's not so complacent anymore. He's going to start. So I think you need a team that will be able to embrace volatility, not fight volatility. And this is the idea of having defenders and goalkeepers. It's not that you're so bearish, you think you're going to lose the match 4-0. No, I think we're going to win. Mm-hmm. But I need to score goals, I need to defend, and I need both. So adding goalkeepers to the team, adding volatility, adding tail risk, adding defenders that will defend under different scenarios. It could be a put option on the yuan. It could be a call option on inflation. It could be gold. It could be puts on the S&P. And then I think it's the balance of art and science of how you build these things. But from a portfolio perspective, certainly things are changing, and I think investors, at the end of the day, I'm just a player, I'm just a goalkeeper. The investor is the coach. You decide what strategy you want to play. Think for the long term, think for the season or the next few seasons. It's not just the next game. How you want to play the season, what sort of players do you need in your team, how are you going to rebalance and embrace volatility and compound on volatility, and how are you going to succeed in level 2 and level 3, which are here and around the corner. And this is why you pointed out something critically important, these misconceptions. This misconception sometimes is an oversimplification of reality, and things that work short term might not work long term. And I think there are a lot of traps in the system, and just need to be careful, because ironically, financial insurance is cheapest when you need it the most. Okay, look at anything, but when the VIX is at 15, and the S&P is at 4,800, nobody wants to buy insurance, right? It's like, and then when equities are at 3,500 and the VIX is at 50, everybody's looking to buy the VIX. No, sorry. This is a game where you accumulate insurance when it's cheap, and you monetize it when it's expensive, and you rebalance. It's not, it's not, the world is not as good at 4,800. It's not as bad at 3,000 a bit volatile. So I think it's a fascinating time and we need to keep this idea that portfolios, again, are like teams, and you need to truly find that true diversification. I think the problem with many portfolios is what I call false diversification. And false diversification confuses two things: a portfolio with a bunch of stuff and a diversified portfolio.
Right.
They're different things. If every single thing in your portfolio is the same trade,
right.
For example, I have a diversified portfolio of crypto. It's an oxymoron. I mean, it's like, what the hell are you talking about? Well, I have these 10 cryptos. I'm diversified. You don't need to be a genius to know that it's the same trade. So don't fool yourself.
Right.
Okay. Don't think you're diversified. And so you have to look for things that are truly diversified by nature, by construction.
Right.
Because when volatility explodes and liquidity thins up and correlations polarize, that's when people are caught sometimes with excessive hidden leverage that comes from things that are very mechanical.
Yeah.
And so this complacency, this idea of the central bank put that mommy and daddy will always have her back, it's a misconception. And I think, again, going back to surviving the game and not getting red carded and winning in the long term, I think will require truly diversified portfolios, where my strong sense is that you need a long inflation bias, because the next decade, unfortunately, I think is the transformation of bubbles too big to fail into stagflation. That's, I think, where we're heading.
Yeah. I love the sports metaphor, because I do think most investors, as they've been conditioned to do over the last 10 years, buy the dip and just put all of their eggs into offensive players. I'm a big hockey fan, and I have a good friend who's from Edmonton in Canada, and he's a huge Oilers fan. They have the two best players of their generation. And so they'll score 4 goals a game. They'll win the scoring titles. But in a lot of games, they'll give up 5 goals a game. And so it's just heartbreak for him every year in the playoffs, because they just can't play defense. And so it's it's very exciting, but it's also not very fulfilling, because they can't really accomplish much.
Buy the dip is a bit like you only play with strikers, because once the ball goes the other way, the referee will call offside. And then who needs defenders?
Right.
Why do I need a defender if mommy and daddy, if the referee is there? You know? And so this idea, this complacency, it's brutal. Of course, who needs a goalkeeper? Who needs a defender?
Right. I want to ask you specifically about gold, because I've been studying gold for the last few years, and to me, from the looks of the gold price relative to negative real interest rates, gold appears dramatically undervalued. I think the thing that's holding it back is the fact that it's had to price in an aggressive Federal Reserve. So it's priced in perhaps the most aggressive tightening path that we've seen since Paul Volcker. And you mentioned that, perhaps they're not going to be able to pull this off. And so that to me would seem like a potential catalyst for much higher gold prices if the Fed is forced into another Powell pivot. Whatever point that comes, that could be a catalyst for much higher precious metals prices. Do you see things that way?
I think, look, every bubble has an anti-bubble.
Yeah.
And just for those who are not familiar with the concept, I coined the idea of anti-bubble as a generalization of sort of Soros' framework of bubbles. I mean, Soros defines, or my interpretation of Soros' definition is, bubbles are assets that are artificially expensive based on a belief that happens to be false, what he calls a misconception. So bubbles are basically situations where the emperor is naked, right? So what happens is, what I did is I generalized the framework, and I said, okay, misconceptions distort reality, but not only through artificially high valuations, you could also have artificially low valuations. And so there are 3 dimensions. The first one is this idea that anti-bubbles are assets that are grossly artificially cheap based on a misconception. They're some sort of mirror image of a bubble, and an extreme value, because it's a matter of when, not if, that they will price higher. The second idea is the fact that bubbles and anti-bubbles are like distorted mirror images of each other. So by construction, the moment the misconception is understood and the bubble bursts and the anti-bubble reflates, it's exactly the same instant, both in terms of catalyst and timing, because they're two reflections of the same process. In fact, it's a reflexive process where, you could see the bubble imploding and volatility going up, or volatility going up and the bubble imploding. This cause effect, it's reflexive, right? And so I called it anti-bubble, a bit like an antivirus or an anti-mishap. It's a defense mechanism against the bubble. And the third dimension, which is this contrarian idea, this idea that insurance is cheapest when you need it the most, is true. Is the reflection of this the nature of the bubble, anti-bubble. So I would argue that gold is in some ways the anti-bubble of the fiat bubble, and it's a bit presumptuous to say that gold is the only thing that right. The only anti-bubble of the fiat bubble. To the limit, most real assets will be. But I do happen to believe that the 2,500 year, 3,000 year history of gold as a monetary asset is no coincidence. I mean, we've tried with copper, we've tried with silver, we've tried with land, we've tried with many things to try to anchor that. And I think gold has this, unique set of physical, chemical, abundance that makes it quite special. And so I do believe that gold has a role to play. I think, there's almost a philosophical angle here with respect to what's the right model and the debate between, fiat and money that is anchored to physical assets. And none of the systems is perfect. But the systems are built on some pros and cons and some premises. And as we discussed earlier, I think it's clear that the system based on monetary and fiat being some sort of act of faith stems from the fact of central bank independence. The minute these things don't exist, and we know that the system is built in a way that it will fail, because faced with war or with a pandemic, of course the central bank, the government will want to tap, and no better way to do it than printing. So in some ways I do think gold has this very long-term strategic role to play. I happen to love it. Anybody who's had gold in their hands, whether there's a coin or something, it's truly unique. I'm fascinated. It happened to be my first job as a gold trader in JP Morgan in the mid-late 90s. But as I say, it's not just gold. There are many things that can play in some way this anti-bubble role of fiat. But I think the fiat, every single monetary broth is set for failure. A lot of people might be thinking about crypto and whether that's the new gold and whatever. I've rightly or wrongly have been very skeptical for a number of reasons. And don't take me wrong, I'm an engineer. I'm the biggest fan and believer in the power of technology and the transformational power of technology. My entire energy book was about the transformational power of technology. And I do believe in the transformational power of blockchain and many things. But that doesn't mean that crypto is worth infinity, or all of them are going to make instant billionaires. I think there's so many considerations, and I think ultimately, there's only 21 million Bitcoin, but you can create 21 million different cryptos out of thin air. And people would argue to that this is like comparing gold and silver and whatever. They're like different needs. And I would disagree with that. I think I had this debate with my good friend Daniel Lacalle, and one of the arguments we used in the energy book when we basically said the last barrel of oil will not be worth millions, it will be worth zero. And trust me, it was incredibly conventional. I mean, contrary at the time people were looking at that. Like these guys from Mars. The point we made is nobody needs oil. Nobody needs oil per se.
Right.
We need to transport, from point A to B in the cheapest, cleanest, most reliable, efficient way, right? And that's why sometimes people get lost and they're like, we need oil. No, we don't need oil per se. If you have a cheaper, cleaner, reliable, abundant alternative, oil will disappear. And so I can see how crypto emerges as this kind of solution. I think my frustration comes with the fundamentalist, movements, almost sectarian. But I understand them, because the minute you open up to accepting that there's more than one solution, then the entire argument of scarcity falls apart. So of course the Bitcoin fundamentalists will want to think that the Bitcoin is the only thing in town and everything else is crap, because as they accept the other stuff is viable and the technologies work and they solve the problem, then everything converges to zero. So I think it's a fascinating world. I can see a lot of the merits. I pointed out in a piece called Bitcoin Bubble Anti-Bubble, which I think we discussed in the last podcast. Many of the things have been playing out letter by letter, and we'll see how it ends. But I find, going back to gold, encouraging from a gold perspective that correlations have been negative. I think the high correlation between equities and crypto is concerning, because it looks slightly more of a striker that could fall into the risk of false diversification, even if it has merits that could put him as defender and a lot of optionality. But I think gold in the right size should be part of people's portfolios. It has a role to play, but once again, I don't believe in a goalkeeper that does everything for everyone every time. So when you build your defenders and goalkeepers, you should have a team. And this is the advantage we have in soccer. You can only have one, and he can only go left or right. Here you could have many more covering the entire goal. And hopefully some of those will play out. And also need to be mindful of what I call the domino effect, which is crisis. Not everything happens at the same time. The stereotypical crisis would be emerging markets go down, and commodities, emerging markets, then developed markets, then that leads yields lower and treasuries and fixed income higher and money printing, and then eventually gold happens. So the gold hedge is not something that will be seen in the first leg of the moves, but it's something that has a delayed effect. So thinking about how to position yourself with hedges across time horizons, underlines, payoffs, taking advantage of volatility, skew, term structures, correlation. That's what we do. We have a lot of fun, creating a team of goalkeepers that will do very extreme asymmetric returns when things go very, very wrong. But we're not the only one. There's lots of great goalkeepers out there, and it's fun.
I would just propose that you've given us a list of the shifts in investor mindset, precipitated by inflation, from financial assets to real assets, from, fixed income to equities. And my friend Peter Atwater has said, kind of a larger version of this is a preference for the tangible and less for the intangible. So that might be, another argument for away from structured financial products and things that are hard to wrap your head around to things that you can, touch and feel and hold in your hand is, kind of part of that larger trend too. So
there's a saying that says reality beats fiction, and it's often used, you do this incredible movie of this terrible serial killer that does these things that are incredible to believe, and then turns out that there's some nutter in Germany that kept someone in a basement for 20 years, and you actually see these things, and they're really hard to believe. You know what reality can bring. So terrible things in both ways. Reality beats fiction. I do think it applies to real assets versus fictional assets. Right. So your point on tangibility, it's important. I think if we bring it up to level 3, then we're going to see also the tangibility of things that are not able to move around, such as, you know, why in the UK you have a wealth mansion and taxes and things like that. So it's in level 2, real assets are awesome and we want them, but yeah, level 3 also factors in things that can be easily taxed or expropriated or nationalized, and that's fascinating. It's yet another complication to the investment game, and it brings you into all sorts of things. You know, gold versus gold equities. I mean, they're both great. They can play different roles, but you know, at the end of the day, they're different things. You know, oil versus oil equities. Everybody understands that. And taxation, expropriation, nationalization are some part of that. So I think the phase where we're now is some frogs have realized what's happening, and the risk might be skewed, and they're jumping already. Some others are realizing it, but they cannot jump because they're handcuffed. Some others are still not thinking in real terms, or might think that they buy in the narrative. Either way, it's going to be a volatile time. You know, jumps, maybe jumping out and some back in, and from frying pans to boiling stuff to things that are all over the place. A few frogs smashed on the floor, and people hunting them. Anyway, it's a very uncertain outlook. We have a number of things that could be relatively binary, like like the war finishing abruptly, or finding some good solutions to things that would be great, but the theta of the system is negative. Every day that goes by with this sort of high commodity prices, these bottlenecks, this fragility, these things is bad news. And so I'd like to be as optimistic as possible and hope for the better, but I think it's a tricky time. And being in Europe, I have to say that this energy divergence is hurting us. I mean, we didn't talk much about energy, and we're probably over time already, but I think there is an angle where it's not so much about crude oil. Crude oil, to a certain extent, is a problem that we're all experiencing, subject to taxes as well, but on a global scale, it's a global problem. We're all suffering from higher gasoline or diesel prices, but the big thing on the energy markets is the divergence across the power and natural gas and others. And natural gas, it was a regional commodity, globalized. It's back to regional. Because of bottlenecks and certain things, and that regionality means that Europe is paying roughly 10 times more expensive than the US, and this is something that I think Europe is going to struggle with. And if this continues or gets worse because of our reliance on Russian gas, I think it's going to take a big toll in the European industry, and it's bad news globally overall. And that's probably the biggest weapon that Putin has. It's not nuclear. I don't think. He's unpredictable and a very dangerous guy, but I don't think he'll go that way unless he's extraordinarily desperate. But I think the energy weapon is powerful. I think even in the current form, with gas still flowing, it's still a major issue. It's strangling Europe. And I think there are large implications. I mean, talking of narratives, nuclear is going to be very green again and very awesome. And so lots of big transformational changes, lots of opportunity, lots of risk. and I think we are in a fascinating time for macro with these transformations that open huge opportunities and huge risks for those who.
Well, it kind of brings it back to the beginning of our discussion, where I think one of the misconceptions behind the idea of persistently low inflation was the idea that we'd have consistent and easy access to low-priced commodities, and that's really coming under question now. But you're right; I've taken up a ton of your time. I know we've used a ton of metaphors today, and at risk of mixing even more metaphors, one of the reasons I love to talk to you is you view markets in a truly unique way. And I know you mentioned before we started recording that you're a tennis player. You use the football metaphor, soccer in my country probably should be called football everywhere. But as a tennis player, is there a particular player that you admire that you think, maybe is representative of you as an investor or what you try to accomplish?
What an awesome question. I wish. No, actually, I'm doing a lot of work on this. It's kind of a life project where I'm realizing the power of analogies, and I think it's my next book. Actually, I'm working on it already, and the frog in the boiling water, or the football team analogy, or many other things help people understand, because we're bringing complex issues into a world of competence. So my mom is an amazing cook, and my grandfather was a chef, and so if I need to explain something to my mom, I do it in cooking terms, and you need the ability to speak both languages to translate the problem. But the most fascinating thing that happens is how my mom will ask the right question in cooking that if I translate it, so we could talk about the soccer analogy, the football team. You could go all day and say, so who's the referee? And, for example, Cash, with a friend of mine, said, yeah, of course, Cash is a striker in the bench. It's like, of course it is. People actually put money on the bench for a while,
right,
and waiting to put him back on the team as a striker, right? And I was like, this is so true, because what happens to the striker in the bench if you leave him there for 3 years?
Yeah.
Atrophy, right? He loses value. He can score goals. He's losing form. So it makes sense. So back to the tennis. I used to play, amateur level, but competitive, and I love the game. I'm a huge fan of the game, and so I love and admire everybody. But Rafa is probably my wife would say it's my fourth son. I really love him, but I have the greatest respect for and admiration and love for Federer, for Djokovic, for Murray, for all these guys. And I think the question you asked me is very interesting, and we could extrapolate to pretty much every investor in some way. But I think Rafa has a particularly good way of looking at the game. And Rafa is the common denominator between all these guys, that they're incredible defenders. Even Federer, people don't realize how good of a defender he is. The serve, which is where you take the initiative, and nobody's throwing you the ball. You are the one who throws the balls and stuff. It's very important. It's how you start the trades, maybe, but once they're in game, or how you defend yourself, and how difficult it is to you need to beat Rafa 3 times before you win a point. But then the way when they're up, how they attack, it's just brutal. So at amateur level, we play a little bit more to the other guy's mistakes sometimes. At this level, you go for winners. And it's fascinating. So I wish I could resemble Rafa in the sense that you can defend aggressively, but once you're up, you go for it. And it's that asymmetry of the game, of how hard is. Rafa protects the score and the capital in a big way, and I don't think it's a surprise that Rafa is actually a very good golfer, and even a very good poker player, because these are games where I think his mindset and plays out that way. You when you're when to go for it, and the asymmetry of the game is fascinating, because when you push this in, and we'll talk about this in the book and maybe another time, but in golf, for example, the asymmetry works the other way around, right? Mm-hmm. In golf, you cannot do a hole in -5. Right. You can do +20. Right. So golfers are naturally incredible risk managers, and they're incredibly good at.
Well, you can't win the tournament on day one, but you can lose the tournament on day one.
Of course. And you can, and so if you think about the granularity of the game and what it takes, if you want to be a really good, and this is something I've done. I mean, we talked about the poker book and one of our first. The Poker Mindset, I think, is one of the best books I've read on the mindset of the game. It's applied to poker, but you can go line by line and use it for markets. And so I think there's a lot of reflexivity in between sports and lessons to be learned, and that's something I'm working on, and it's a lot of fun. But I think tennis has many things that relate to the game. But every game, I'm a big chess player, so there are great things about chess that you can apply, but it's a game of perfect information, so it's not, poker is closer, so it's a fascinating Frankenstein you could create from analogies and things. So that's what I'm working on, is kind of doing a little bit of, it's just for fun.
Well, I think it's fascinating. It's very helpful in explaining a lot of what's going on, because so much of what's going on in the markets is so esoteric and hard to understand for people, that when you do explain it via metaphor, it's helpful. I'm a huge tennis fan. At Indian Wells, I was glued to the screen watching Rafa versus Alcaraz, and the future. Oh my gosh, the future
even
of
on TV, you could see it.
It was brutal. And they were both, just battling. They never give up, and it's just, it's fascinating to watch them play defense first. And it reminds me of, every great investor you talk to. Rule number 1: don't lose money. Rule number 2: never forget rule number 1. And that you see them play that on the court. So that's fascinating. Diego, thank you so much for taking your time to do this today. Is there a place where people can go to learn more about you and what you do?
Well, look, first of all, you're very kind. It's always a lot of fun. And I took some notes, things I enjoy about these chats is that it's like sparring in boxing, you get better. And so thank you for coming all the way and taking the time. And I invite everyone to come to Madrid and enjoy this lovely city and country. I'm not as active on the social media, but I do have accounts with Twitter, Parrilla_Diego, and LinkedIn. I now have a newsletter. People can subscribe for free. It's called the Anti-Bubble Report, as part of the. It's easily to access via Twitter, and in general, we do this all just for the sake of spreading and learning, and I find the process of writing very educational. I think Cicero said, if you want to learn, teach. And I think if you want to learn, I would say you write. So I do these things, but they provoke me. And I hope people will find the newsletter helpful. Ultimately, a number of people have also invested along with our strategies, which is the main thing we do. But they're very closely related. Having the big picture correct, implementation, and so. Yeah, people could subscribe to the newsletter, and I look forward to feedback and again, these conversations are super enjoyable, and I always learn something, and you might see the level 0 appear with the relative game in future conversations, but yeah, I hope people find this helpful, and I'm happy to engage through the media and the newsletter, and I look forward to any feedback.
Yeah, absolutely. And I think, it's a wonderful thing that you've put out the new newsletter. I think it's must read for me every time it comes out. I'll put a link to how to subscribe to that also at thefelderreport.com. And I also have to highly recommend Madrid. I've had a wonderful time since I've been here. It's taken me, it took me way too long to come visit, and it's been wonderful. But thank you, Diego. We'll have to do this again, hopefully, in maybe another year. It's lovely to check in with you.
Thank you so much. It's been my pleasure. Thank you.
Sound on it for the 142!
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.